All right, guys, welcome back. Grab a pen and jot this down. Today, we're going to talk about merger arbitrage, the mechanics of the trade. It's a very popular topic. It's a way to make some risk free money. It's very popular on the street. There are different ways to view catalysts, different ways to look at the mechanics of how buyers and sellers look at this, how investors are involved, and what's happening with companies during a long time period of going from uncertainty to certainty before closing a deal. So quickly talk about the types of deals that happen so you understand them. There's all cash, so you straight up just wire money to buy a company for like $1 billion. There's cash and stock, so it's a combination of the a cash component and then the stock of the acquirer is going to offer something of a value at a certain date, and then all stock, and that's probably the most risky. But what happens in the world, so like the best example right now is happening is JetBlue is trying to acquire Spirit Airlines, and the reason is in the airline industry, companies have different regions of the world that they own, and if you own specific regions, you get access to specific airport terminals, you get preference, and then you can either look at it versus on a cost economies of scale or revenue synergies, depending on how you view investment deals. And in most cases, cost synergies are worth way more than any revenue synergies because revenue synergies are very difficult to execute. And the reality is that shoppers, when they go to somewhere, let's say like they go to a grocery store aisle, it's unlikely they're going to buy two products that are complementary. Let alone like there's very little crossover if you think about products across. If you look at someone's shopping cart, but cost synergies are great because they deliver economies of scale, meaning you're going to generate a profit over a certain period of time. And if you generate more, you become more competitive, and that profit widens because your cost goes down and you expand your reach. So, Spirit Airlines is not the best airline, but JetBlue is also, it's not a premium, not a luxury like Delta or something, but like they could still probably upgrade Spirit. They probably provide more offerings, maybe at a lower price, but still, it's great for them. So anyway, in this case, I think they're doing a $7.6 billion deal. Um, Spirit shareholders will receive $33.50, and then the rest I think might be in stock or some form. So in the case like what happens usually, so in this case is the $94 million breakup fee. So an announcement was made sometime in I think August. The deal was announced, said, "Hey, we're going to acquire the business. We'd like to buy it for this price, $31, $77.6 billion. Estimated closing date is the second quarter of 2024. Because it's a large company, there's a lot of regulatory uncertainties and hurdles you have to cross. So when you cross those hurdles, you increase the level of certainty. In this case, there's I think it's the Scott Rodino Act where you have to say, or the Hart Scott Rodino Act where you have to say, all right, when you acquire a business, you're not anti-competitive. You're creating an environment where there's new business to be made. Customers are not going to have the fear of pricing increasing, prices increase. So in this case, last year when they made the deal, there was a lot of uncertainty because I think Frontier was trying to buy Spirit. JetBlue jumped in, said, no, we want to buy Spirit, so we're going to give them a premium. Shareholders approved that deal because it looked better. JetBlue is a better operator, et cetera, et cetera. But the reality is there's so much uncertainty in the market, one, because of the COVID and traveling fears. And then on top of that, two, there's still so much uncertainty about making this stuff profitable because airlines are actually very expensive businesses to run. So in this case, airlines have a fixed cost, $20-30 million per jet. Both companies have very similar fixed costs, so maybe they can reduce. So if they have 40 jets at JetBlue and 30 jets at Spirit, now they'll have 70 jets. When they have to make a purchase order for another 60, 70 jets in 5 to 10 years, they'll probably get a discount, let's say 5%, which is a huge cost savings when you're spending, a billion to $2 billion plus to buy your inventory. And then you have to focus on the ticketing, and then you say, all right, how is it ticketing price at different terminals? How is service at different vendors, like a Priceline, etc. And you'd be like, all right, we could probably, if we do a $7.6 billion deal, we'll probably save $200-300 million in costs. We'll make the money back in a 5 to 7 year period, And what's the biggest concern right now is probably regulatory, and then as long as nothing happens to the industry. So how does M&A work? M&A, risk-free arbitrage, work? So if I'm an investor in Spirit Airlines, the date of this video, the stock is trading at like $19. The deal is supposed to close at $31. So there's actually almost a 61% return possible for this deal. And the reality is that the $10 to $12 spread is a level of uncertainty that's in the market, meaning you could buy the stock for $19 and say, hey, this is going to close at 31, but if it doesn't close, the stock will probably go down to the pre-M&A price, maybe like 10, $12 or something. So you got to figure out your risk-reward ratio. So a lot of hedge funds will go out there and say, hey, I'm going to see what's the price of the current stock, when will it close, can I hedge the position, so maybe I can buy $19 equity stock at that price, and then maybe sell calls across the board and maybe buy put at a certain price, so I can hedge and collar my position at either 19, 23, pay more premiums, and then reduce the probability of a loss. So you might be able to write some calls at like a 17, 18, and then 20 and above, and then buy put at like 15, and probably like you cover your insurance, but what happens is your cost of insurance. So if the stock drops more than below $15 or something, you won't risk too much. But if the stock goes over 27, which is going to close at 31, you're probably going to make 30 to 40% over a period of time. So those are the ways to think about it. The beauty of these deals is that you have an idea of when the closing date is. So another deal I saw this morning was technical consulting business, the engineering business in Houston. It was rolled up by three different private equity firm. Private equity firm rolled up three different engineering businesses, put the deals together, and said, all right, this is now $600 billion business. Three companies individually were $100 million. Keep operating the business, make them work together, improve the operations, and then when they went public, another private equity company called GI Partners came in and said, hey, we're going to buy you guys for $1.2 billion cash. The stock went from like $10 to $12 because the closing price was going to be $12.25. So now you have less than a 5% spread. Premium has dropped. And then you can basically say, all right, it's going to close in 30 days. I can hold this position for the next 30 to 60 days, wait for it to close. And I might make 5% over 30 days, but the reality is if you analyze that, you actually make 60% on the cash being held, and that will juice up your returns. It's risk-free in some form. They actually call it risk arbitrage because there's always some type of risk involved, but you can price out a lot of the risk and say, all right, this is a level of certainty I'm comfortable with, I can close the deal. So the introductory of what M&A is kind of like. There's a lot more that I'll break down in the mechanics of different trades, and then I'll provide more live updates as these deals happen over time.